Good afternoon. Thanks for joining us. My name is Doreen Carlton. I'm Executive Director of Mid-Atlantic Staffing Association. And today we have with us three partners with Citrin Cooperman Accountants and Advisors who will be bringing us up to speed on recent changes to the PPP legislation and some advice for next steps for your business. So please welcome BJ Hoffman, Mike Napolitano, and Mike Zaborowicz. Mike Zaborowicz is going to kick us off.
Dorian, thank you so much, and thank you everybody for joining us today. Certainly been a strange time, especially over the past couple of days. So I hope everybody and their families are staying safe. Today we wanted to have a webinar aimed at helping staffing companies navigate the COVID-19 crisis, continue to navigate it with a focus on PPP loan forgiveness and next step. Obviously, still a very fluid situation, and there's some legislation out there that could change things. But it's still being kicked around, so we wanted to provide everybody with an update on where things stand, with maybe a glimpse onto what to expect. We also wanted to tailor this whole presentation specifically around staffing companies, and talk about some staffing industry specific questions and scenarios related to PPP loan forgiveness and other COVID-19 issues, and then talk about how those companies, whether clients or contacts, have handled them. Just to provide you with some additional insight. So my name is Michael Zaborowicz. I'm joined today by BJ Hoffman and Mike Napolitano. We are the co-leaders of the Citrin Cooperman staffing industry practice. Citrin Cooperman is a full service accounting firm. We provide audit, tax, consulting services to probably more staffing companies than anybody else in the country. So, we wanted to keep this as an intimate group. Due to the size of the group at the end of this, at the presentation, what we'll do is we will open it up for questions. Feel free to type in the questions in the Q&A, but it might be, because of the size of the group, it might be just good to open it up to live discussion at the end of this. So just, you put, the hand up signal in your toolbar, and Stephen will call out on you, and we can have the discussion live. So to kick us off, BJ Hoffman will talk us through what the recent developments are over the past couple of weeks related to PPP loan forgiveness.
Hey, thanks so much, Mike. Hey, everyone. Good to have you with us. Hope everyone's continuing to be healthy at home. And so the PPP continues to be a hot topic for staffing firms and for all firms. If you've been following along, and certainly if you've applied for PPP funds or received them or tried to deploy those funds, you know that this program has been marred by, a process that's been rushed and vague and often contradictory at times, particularly with regard to the application process, the forgiveness process. It's made it really hard as advisors who strive to give cogent and timely advice to stay in front of this thing. And again, as you'll hear, though we have gotten a lot of clarity in the last 2 weeks, that all can change as of this week. Certainly tomorrow, there's legislation moving through Congress, which we'll touch on as well. The good news here is as frustrating as this has been, the PPP program can be a really meaningful financial event for staffing firms. At a minimum, PPP funds present and offer a really cheap source of capital. 1% interest rate with a payback period over a couple of years. And at best, if you secure a maximum loan forgiveness, it can be a really meaningful payroll subsidy that falls out to the bottom line. So the program, although difficult and marred in its rolling out and application, can really help out a lot of staffing firms. So here's what I'm going to do. Let me talk to you about the updates that have occurred over the last 2 weeks. I'll also touch on what we are advising our clients in terms of maximizing PPP loan forgiveness. And then my colleagues will certainly take it from there, and we'll talk about what's coming down the pike and where we move from here. So let's jump into what has changed over the last 2 weeks. First of all, the good news is that absent any major criminal undertaking on your part, nobody's going to jail for accepting PPP funds. There was talk several weeks back about the notion of eligibility and whether if you applied for funds but were not eligible to receive funds, what kind of potential penalties you might be facing. That's been clarified in large degree, certainly for those that have received less than $2 million in PPP funds. The presumption is that you are eligible no matter what to partake in the program. For those of you that are receiving more than $2 million in PPP loan funds, you should expect an audit, and you should certainly be speaking with qualified, knowledgeable outside counsel as far as documenting, memorializing on a contemporaneous basis your eligibility for the program, which can often speak to your liquidity and you know, the notion of whether you did or did not have other means of financing your operations. So, you know, the threat of major sanctions and criminal penalties are largely off the table at this point. But certainly if you've received substantial loans, you need to continue to monitor eligibility. So over the last 2 weeks, what has changed? The SBA and the Treasury has issued the actual loan forgiveness application, which is floating out there. And there's been additional interim financial guidance issued that answers more questions. So we're seeing the picture come into focus to some degree, and a lot of our questions have been answered to date. There are certainly still some open questions that have not been addressed. And as I alluded to, some of the rules and some of the significant rules can change this week, and we're just going to have to monitor. So what have we learned over the last 2 weeks? Well, first of all, we knew that there was this notion of a reduction in your loan, PPP loan forgiveness that was floating out there. And there's a couple of different, I'll call them loan forgiveness haircuts that borrowers are exposed to. The most significant, the most major one of those potential loan forgiveness haircuts relates to the size of your FTE workforce headcount, FTE full-time employee equivalents. And the notion that if your headcount was high pre-crisis and has been reduced post-crisis, and certainly during the eligibility and measurement period for your PPP loans, that you were going to be open and subjected to a forgiveness haircut. The FTE forgiveness haircut was driven, though, by the notion of FTEs, of course. The problem was nobody defined how you were to calculate FTEs. We had assumed that, absent any further guidance, that the calculation of FTEs would be akin to what we saw in the Affordable Care Act, which was essentially a 30-hour work week. And you divide the hours worked on a weekly basis by 30 to come up with an FTE equivalent. And that would be the way you evaluate FTEs in your headcount. Well, as of 2 weeks ago, we got guidance. It is not a 30-hour work week. Instead, it's a 40-hour work week that is presumed. And anyone working, any individual working more than 40 hours a week is considered to be one FTE. And if you had people working under 40 hours a week, let's say 10 hours a week, that person would be a quarter or 0.25 FTE for the purposes of all of our calculations. I'm going to circle back to this because there's some choices we have that have been set forth for us that can meaningfully impact the way in which you calculate loan forgiveness. But we did get some clarity there, which was good. We also knew that for the purposes of calculating forgivable or eligible payroll during the measurement period, the PPP measurement period, we knew that highly compensated employees would be capped in terms of eligible payroll at an annual $100,000 basis. So for an 8-week measurement period, 8 weeks divided by 52 weeks times 100,000 is $15,384 over an 8-week period that a highly compensated employee would be capped at for eligible payroll for forgiveness. What we did not know was whether there was a further limitation within the 8-week period that might limit weekly highly compensated employee forgivable payroll to $1,932 a week, which is essentially one week over 52 times $100,000. Well, we learned that there is no such weekly cap. Instead, it is an aggregated cap over the 8-week period. So the $15,384 is really the dollar amount of payroll during the 8-week period that you have to watch out for, and you're going to be limited at for any highly compensated employee. A big one, big clarification that came out over the last 2 weeks was this notion of whether loan forgiveness is an all or nothing proposition for your PPP loan. Though we were reading the regulations that indicated to us that it is not an all or nothing proposition, there were some advisors out there saying that it was. Best way to show this is by way of an example. So if your PPP loan is $1 million, and over the 8-week measurement period after receiving that loan, you only spent $50,000 of the $1 million on payroll. There was the question of whether potentially because you did not spend 75% of your loan proceeds on payroll, whether there would be no forgiveness whatsoever. Instead, given that example, if you take the $50,000 that was spent on eligible payroll over the 8-week period, divide that by 0.75, 75%, that yields a figure of $66,667. That $66,667 would be your maximum loan forgiveness in the example that I set forth for you. So essentially, you'd be getting forgiveness for the $50,000 you spent on payroll, and additionally, up to an additional $16,667 for other forgivable costs like rent and utilities. Again, some were saying that if you didn't spend $750,000 of the $1 million on payroll, that there'd be no loan forgiveness. Well, that's certainly been clarified now, and that's some good news for all of us. Another item, sort of housekeeping that was made easier for PPP loan participants over the last couple of weeks has been the offering of an alternative covered period, it's called, for payroll measurement. So at the outset of the program, we knew that the receipt of PPP loan funds started an 8-week meter or clock that was ticking under which you needed to spend those funds. Often that 8-week period would not in any way align with any business's payroll period, which caused some headaches as far as administration goes when you have a payroll period for yourselves that is not aligned with your loan forgiveness period. Well, now just for payroll purposes only, you are allowed to elect again, an alternative covered period which indeed will align with your own internal payroll period, which should make some record keeping easier in terms of determining what your eligible payroll is over the PPP measurement period. So that should help out. We also learned over the last 2 weeks that some of these other eligible costs for forgiveness, rent and utilities, that the rent is not just for your office rent, but is also eligible costs include rent for tangible personal property, like copier leases, postage meters, even auto leases, to the extent that those leases were in place as of February 15th, 2020, and the expenses were spent or during the 8-week measurement period. Again, that would serve to open those costs and payment for those expenses up to forgiveness. So all these things over the last 2 weeks gave us some clarity as far as how to apply and achieve maximum loan forgiveness, which is great. But again, a bit of a moving target. Next, so what are we telling our clients right now about how to maximize loan forgiveness? Well, a couple of things. First of all, we know that the largest driver of loan forgiveness during that 8-week measurement period is payroll-related costs. What we did not know until the last couple of weeks was whether things like bonuses or hazard pay supplements would indeed be treated as eligible if paid during the 8-week period. And we've come to learn now that yes, indeed, hazard pay and bonuses are theoretically eligible payroll expenses during the measurement period for PPP forgiveness, which is great. Now, I'll caution you that trying to shoehorn your way into maximizing loan forgiveness by accelerating bonuses into the 8-week period and potentially doing things like trying to claw back compensation after the 8-week period is up is sort of gymnastics that would probably be frowned upon if a loan auditor were to take a look at what you were doing. So really, we encourage you to carry on and conduct business as usual, but to be sure, bonuses, if they relate to the 8-week period, or if you have hazard pay supplements being offered to your contract workforce, they should be eligible payroll costs, again, to the extent that you're keeping below the $15,384 of ceiling for highly compensated employees. So that's good. The next planning opportunity relates around this FTE headcount and potential haircut to your debt forgiveness. So first of all, as I alluded to and mentioned, we now know that the FTE calculation is a 40-hour work week. What you now have been given the option of, though, is to employ this 40-hour FTE calculation in one of two ways. You need to be consistent, but you have the option to select from one of two methodologies. The first is individual by individual for those that are working over 40 hours a week, treating them as one FTE. And then for those that are working under 40 hours a week, treating them as the appropriate percentage. In my example earlier, if someone's working 10 hours a week, they are 0.25 FTEs. Alternatively, the alternative approach is treating anyone working over the 40 hours a week as one FTE, and treating anyone that's working less than 40 hours a week broadly as a half, 0.5 FTE. Depending on your unique business circumstances, that calculation or choice of methodologies can yield dramatically different results from a forgiveness perspective. So you need to crank the numbers both ways in order to see what works best for you. We also know that you have a choice of historic base periods that you can look back to and use to compare your current headcount with. And that choice is choosing either an FTE period of February 2019 through June of 2019 as your base period, or alternatively, January 2020 through February 29th, 2020 as your base period. You want to generally use the FTE base period that is the lower FTE count, because if you have a reduced workforce, you're looking to minimize your loan forgiveness haircut, and having a lower starting point would mean less of a reduction in your headcount and therefore less of a haircut. So you need to work those numbers both ways also. We may now be able to, and we've come to learn that we may be able to during the 2-month or 8-week PPP measurement period, we may be able to pay rent and utilities that relate to more than just the 8-week period. For example, rent, you may now be able to pay back rent before the crisis, from before the crisis, or even during the crisis. You may be able to pay rent that is allocable to those periods. If you pay it during the PPP measurement period, you may well now find that those costs are forgiven. The same holds true for utilities. There also may be a way to get 3 months of utilities or rent squeezed into the 2-month period. So you need to look and try to maximize your payments during the PPP forgiveness period associated with rent and utilities to try to maximize forgiveness. To be sure, regardless of any of this, you need to maintain good records. You need to have good interaction with your payroll provider so that you can slice and dice these numbers and figure out what works best for you. It's an undertaking that is truly math-centric, and it really means that there's an opportunity to get additional forgiveness if you select the options that work to your own benefit. So that's a quick update on what's been going on over the last 2 weeks. Mike's going to take it from here and talk about what's coming next and a lot of those unknowns and the guidance that we're issuing.
Yeah, thanks, BJ, for that, for providing that summary. And obviously, we can spend hours talking about PPP, and we'll certainly try to address everybody's questions, but I think it gives an idea of where things stand today. Now, having said that, I think we'd be remiss if we didn't talk about, a couple other things. First, BJ did mention the PPP documentation. The loan application does tell you what you need as support. And so one thing that we would say is to, look at it and start to put it together. You have 90 days from, the loan receipt date to submit the application and the supporting documentation. So you don't want to kind of get caught flat-footed, not having a lease to provide as support, as a forgiveness thing. And BJ talked about payroll records. There are payroll companies that they are coming up with reports right now, ADP paychecks, that will help you exactly provide what SBA is looking for. So, start on the, don't put off the documentation to the last minute. The other thing is, you see I think it passed the House and it's getting kicked around in the Senate. It's the PPP Flexibility Act. Again, some of this might flip everything that, we talk about on its head. It's again, but we don't want to highlight things because at this point there's still different options on the floor. Couple of things to highlight that are being discussed. Extending the 8-week period to a 24-week period, which would kind of take you to essentially December 31st. Lowering the requirement 75-25 for payroll costs, versus non-payroll costs. Moving back the 6/30 date to get back to full employment. And then extending the 2-year loan date. So, some major things that are being kicked around, but again, it's still likely to change. So it's one of those things where, stay tuned. But certainly some of the basics that BJ talked about, are going to stay. Some of the dates might change, but a lot of the items that were defined and outlined in the application and in the 2 interim rules that BJ talked about are still going to hold true. So, this kind of brings us to talking about, we talk about how to maximize loan forgiveness. The flip side of it is we talk about with our clients as not chasing forgiveness. What I mean by that is packing it to the 8-week period, where that money might be better served during a ramp-up period. Obviously, if they extend the 8-week period to 24 weeks, that kind of changes the landscape. But certainly consider if you are in a industry or a vertical such as hospitality, again, that money might be better served when you start to open up or ramp back up. Again, problem might be solved if they extend the 8-week period to 24 weeks, but as of now, maximizing forgiveness works for most people, but maybe not for everybody. And that kind of brings us to the next point, which is, keeping with the basics of dealing with the crisis. I think at the onset of the pandemic, most companies were looking, for ways to preserve cash. That meant cutting back on spending, optimizing internal payroll levels, looking at funding sources and evaluating, the different opportunities that were out there through new bills. You had the EIDL loan, the PPP loan, the Main Street loans, which kick off this week, the tax credits that are out there, but I think what's important is, in order to make informed decisions, companies need to prepare cash forecasts or a 13-week cash flow forecast. It's vital. How else are you going to accurately determine how deep to cut or how much additional funding you need? So, when the PPP came along, it became an obvious choice for anybody that qualified. But ironically, the PPP loan program has forced a lot of people to start this process, right? You're doing. You looked at eligibility. When you looked at eligibility, you looked at liquidity sources. You're looking at weekly expenses. And so, as you're dealing with the continuing fluidity of it, now more than ever, I think it's important to analyze how you manage your cash flows. A 13-week cash flow forecast will just be an extension of what you're doing during this current PPP 8-week period or longer if laws get passed. But, it provides you with an understanding of your anticipated sources and uses of funds over the next 90 days. And again, it's vital, in the next steps in decision-making process, especially if you received funds, how best to use them, right? So let's just take a, whether you're putting this together or whether an outside provider is putting, a cash flow forecast, together, what are some considerations that you should have? On the receipt side, you talk about collections, right? Collections have been slowing. Is the trend continuing, right? Customers have been, in certain industries, have been heavily impacted. Are some of them going through bankruptcy? Looking at your aging and communicating with your clients, I think is vital. Extending, clients have asked for extended payment terms as well, right? And all this for a lot of staffing companies is affecting your borrowing base. And anybody has an asset-based loan probably has a borrowing base based on eligible receivables, anything under 90 days. In the beginning, we talked about, reaching out to lenders and extending the 90 days to maybe 120 on national clients, 150, and banks have been open to it. But again, it's something that needs to be factored in when you're doing cash forecasts. When you look at other sources of funding, some people put in their own cash as a source of funding. Well, tax time's coming up and people take distributions out to pay their taxes. And so, doing a cash forecast, I think, is important to determine, am I going to be able to take cash out for taxes, or am I going to need to, have that in there for cash flow purposes? On the expenditure side, what's essential, what's not essential? We talked about negotiating with landlords and, either using security deposits to pay or pushing back, deferring rent payments. Landlords have been open to that. When you look at people working virtually, the idea is, do you even need as much space as you had before, right? Looking at compensation levels, revisiting compensation plans, sales teams, making them, more incentive laden, performance based. Management, I think there's going to be a lot of competition for top management level people over the next couple months, and so, is a profit sharing plan something that would be in the budget? As you start to ramp up, cost to be hired, cost to retrain, all has to be considered in your cash forecast. The cost of social distancing guidelines, we already seen you're probably gonna have to spend more on supplies, more on cleaning. Workspace, is your workspace even conducive to the current environment? If you had an open workspace, open work plan, you might have to buy additional equipment to change that. I think that's, somewhat obsolete at this point. And working from home, if people continue to work from home, are you gonna have to provide them with some additional equipment? So all considerations, for this cash flow forecast, and update it weekly, compare it to actual. If you want to get a little bit more sophisticated, you look at cash projections. Cash forecast is the most likely outcome. Cash projection, you have different levels of it based on what your anticipated, levels of revenue, opening, of that is. And whether it's cash forecast or a cash projection, I think these are just components of an overall larger strategy or business plan. So as you look at your current business plan, is it set up for crisis management? More specifically, is your business model set up to handle a crisis like this, or do you need to adapt, right? So, do you have to get into new business lines? Or if you're in multiple verticals, are you going to have to move some of your assets from a current vertical into, more thriving verticals? Some verticals are struggling, other ones are thriving. Employees, certainly an uncertain time for many employees. And so, the question has become, are you communicating, your plan with your employees? If you look at your employees, are they working in the right roles? Before this came about, I think robotic, process automation was a hot topic, certainly in a lot of the conferences. And so, looking at your budget to see if technology can help push some of the high performers up to, higher levels and not work on the remedial tasks, right? So, and most importantly, I think it's, ask yourself the question, do you have strong relationships in place with external advisors that can help you answer these questions? I mean, certainly a lot of service providers, whether it's bankers, lawyers, consultants, accountants, provide commodities, and these commodities are a lot less important during times like this. So the question is, can they provide you with value-added services to help you not only survive, but come through this stronger? So all things to consider as next steps beyond the PPP, although, at this moment, we recognize that is something that, most people are focusing on. So next, Mike Napolitano will talk about, some of the common topics and discussions that we've had with other staffing clients and how they have overcome, some of the recent struggles.
Thanks, Mike. Good afternoon, everyone. So I'm just going to spend a little bit of time going over what we've been doing with our clients, some of the general conversations that we've been working through over the last 9 weeks. As BJ and Mike said, the key word is fluid. So we've been trying to stay in front of everyone, providing them information. So with the loan forgiveness, we have certain clients that every week are interested in what the loan forgiveness will be. So we have examples of clients will send us their weekly payroll reports, which will show the wages, the full-time equivalents. So we're looking at and assisting them on projecting what that loan forgiveness will be. We're running different scenarios if they bring on 20 more people in a week or two, because they want to know what's the impact. And one of the things we always say is you can't lose sight of what the costs are for bringing back people. So a real example is I have an IT staffing firm who is probably at 90% of his full-time equivalents. He's made the decision where he's going to bring about 30 people off the bench and pay them. Why? The fear is with the changes that have come out with the SBA and the constant updates, his thought process is to have people paying them while they're on the bench to accomplish the spirit of the PPP plan, which is to bring people back on payroll. So that's a decision he made. He's being ultra conservative. We ran what the cost would be of having those individuals sit on the bench, because you can't lose sight that you're still responsible for the payroll taxes, the unemployment insurance, and workers' comp. So that's the decision he's made, and I've had these conversations with multiple staffing firms. Should we do this? And it's an individual decision that each business owner is making. So something that certain business owners are looking at. The other big question we're getting is planning for the post-PPP loan conversion. So as Mike described, depending what vertical you in really determines how hard you've been hit. So in the hospitality industry, we have a staffing firm that's down 90%, and they're located on the West Coast. So the question becomes, what do we do with the PPP loan? And as Michael described, is if things do turn around, it may be helpful to have some liquidity to cover those costs. Now, certain staffing firms have traditional lines of credit. I've had 2 staffing clients where the banks have already reduced those lines of credit based on what is going on. So in addition, we're also telling everyone to have discussions with your bankers now if you think you're going to have issues with your bank covenants. That is not something you should be waiting for. Have those discussions today. So each staffing firm is different in the needs and the position they're in. So some of the pros of converting the PPP to a loan is you have no payments for 6 months. So one of the concerns is, what if this hits again? So we've gotten plenty of calls saying, what if this does occur again in November? What benefits will the government be offering, if any? How much money can they print? So some of our staffing firms have already decided, listen, I will convert any unused PPP to a loan, because since I have 6 months to make my first payment, which will bring most business owners to January, it gives them some confidence, some comfort that they have liquidity for 2 reasons. A, if they do ramp up, they have the liquidity to cover the payroll. But B, if we do have a second hit, they have some liquidity at their availability. So something to think about. The cons is just understanding the impact that loan will have on your balance sheet. Understanding what the impact is with loan covenants. So it's something you have to look at a little more closely. I'd encourage everyone work with your professional so you understand the impact. Also have the discussions with your bankers early if you do believe the loan covenants are in jeopardy. I've had plenty of staffing firms that haven't met their covenants. Many banks will have some type of fee associated with that. But we also say have a game plan. Don't just go to them and say, hey, we're not going to meet our covenant. Have a game plan, be proactive, have them involved in those discussions. So something to think about. Other issues we're dealing or having conversations with the PPP and meeting the payroll requirements are recruiters. The commissions are way down, especially if you're in the Northeast and on the West Coast, being closed and shut down. There are many commissions that have not been earned and will not be paid. So many of our staffing firms are increasing the draw during the 8-week period, essentially prepaying those commissions, which just creates an administrative burden on following those commissions when they are earned, so you have appropriate accounting. Another incentive is we now have clients that have positions to fill and they can't because of the unemployment benefits. So I've had 2 of my staffing clients, especially on the light industrial, where they are offering more incentives to their recruiters and trying to fill those positions. So something to think about. As I just mentioned, an unintended consequence of all of this are the rich benefits of unemployment. So we are now dealing with multiple staffing firms who cannot fill positions. They cannot bring staff back. So what has happened is many of our clients working with their legal team is they're putting in writing the offers to bring back the staff, basically sending out a letter saying, you know, this letter is putting on notice your position is available. The reason why we're doing that, it also helps you with your full-time equivalents for the PPP. So if you do offer the position and it's rejected, it allows you to still include that person in the full-time equivalent. In addition, it's having a written notice that they did offer the position back. And many of these letters will state that if you do reject this offer, you have to inform your unemployment agency and you may not be eligible for unemployment benefits. Some of the conversations with our owners is, especially with internal staff, is that's great. They come back, they're going to be upset. I'm going to have an upset employee because I could have been making more on unemployment. So it's a case-by-case decision with many of our clients on what to do with bringing employees back. Another issue to definitely consider is the third part of planning, which should occur after the PPP process is over, is there is going to be a tax consequence for the PPP funds. We have staffing firms that have received PPE loans anywhere from a couple $100,000 to $10 million. So there is an economic reality come year end with the receipt of these funds. So any forgivable portion of the loan will essentially become taxable income. So we've already started working with our clients and planning for that come summertime. So there is plenty of notice, there's plenty of planning that can be done to account for that. So just keep that in the back of your mind. I know we're all focused on getting the funds, using the funds, but we don't want you to get whipsawed at the end of the year. Add to that, if you happen to have a rough fourth quarter where your placements are down, your revenues are down, you can certainly get hammered with taxes because typically a strong fourth quarter will do a lot of the tax planning for you because you're incurring the payroll costs and you're not getting paid to the following quarter. So just make sure you're doing your tax planning. Another question we're getting is, over the next several months, you'll be subsidizing your payroll with the PPP funds. So a lot of our staffing firms have inquired, can I pay down our line of credit as we're building up cash flow? And the reason why they're asking is PPP funds cannot be used to pay down debt. Most of our clients have segregated the funds where the PPP funds are in a separate account, and we're managing those funds to pay payroll, rent, and utilities. But that doesn't mean in your normal operating account where you're building up excess cash that you can't use it to pay down debt and reduce your cost of debt. Questions that have come up is, when forgiveness time comes, will the SBA, all of a sudden look at us and say, holy cow, you now have $5 million sitting in your bank account. Some of our clients are a little fearful because the rules keep changing is, what if we're sitting with a lot of cash in the account? How will that be viewed? So some of my clients have said, listen, I'm going to pay down debt. I'd rather show less debt. At this point, there is zero indication that the amount of cash in your bank will have any impact on forgiveness. But again, because the rules are changing, just want to give you some insight into what our clients are thinking. So some are keeping the cash liquid, others are paying down debt. So just something to think about. Post PPP loan, we're looking at about a 6-month process before the loan is forgiven. So by the time the bank processes the paperwork, I think they have 60 days to hand it off to the SBA, and the SBA, I think, has 90 days for forgiveness. So some of the questions and conversations we've had is, let's assume the economy picks up. Summertime, we go into a strong third and fourth quarter, and you received $5 million of PPP funds. And the reality is that year end, you're sitting with, or coming into year end, sitting with $5 million more in cash. What do you do? So we've been hesitant to say bonus it out, take large distributions, because again, we're just not sure how the SBA will look at that. We don't even know if they're going to look at transactions post 8-week loan period. But just common sense discussions we're having, it's probably not a great idea in September to take a $5 million or $4 million payroll bonus, just so we get through this process. At least wait until we get the full guidelines on what the period they're going to look at, if it's going to be extended. So just some of the conversations we're having. I know I went through quick what we're dealing with, but feel free to inquire, ask any questions with the remaining time we have.
Sorry about that. So Mike, thanks for that update. And so at this point, I think we'll like to open it up to for questions. I think BJ, some of the questions were answered online. We can certainly talk about them. But Stephen, anybody have any live questions that we can discuss?
Not yet. If you do, though, please use the raise hand function and we'll bring you up live. Oh, here's one right now. Jackie. Don't forget to unmute yourself. There you go.
Hi. In Pennsylvania, where employers are starting to move employees to remote offices and they may not go back to a corporate office, what expenses are Pennsylvania employers responsible to pay? So I was on a conference prior to this, and it was a lawyer, and he was talking about New York. He was head of their staffing, saying that in New York, you had to pay. There was no laws, but in Pennsylvania, there are laws that require a percentage of the phone, percentage of the internet. Do you happen to know what those stipulations are?
You guys, I mean, I don't, that's more of a legal question. It's certainly an HR sort of labor law question as opposed to an accounting or tax question. Either of you familiar?
Yeah, no, I haven't heard anything specific to Pennsylvania at this point. I know that a lot of it has, stuff has come out over the last couple of weeks, but I haven't heard of any specific requirements that employers are on the hook for at this point. But certainly, whatever we can become aware, we can share with Dorian, and then Dorian, you can kind of send it out to, I know, a large portion of our base is Pennsylvania based, so we'll certainly share that, but I have not heard from my end.
And one other question, you talked about copier leases being tangible assets. What about software packages that we use for recruiting?
So this is a very common question. It's a bit of a gray area, but the instinct is that software costs are more of a license and less of a true rent, and certainly not a rent of tangible personal property if it's a license and the rights to use it. So I'd be real careful about making the assumption that you could use software costs, treat them as rent, and then make them eligible for forgiveness. You guys agree?
Yeah, And Jackie, I think that, you know, when they came out, and I'll talk about it briefly in a moment. They came out the interim final rules, and the hope was that they would give some specific examples of, you know, for example, they said transportation can count as a, you know, non-payroll cost. Nobody knows what that means. So,
Yeah.
you know, that's one of the things that I think, you know, they said, you know, they expanded it to not just, you know, rent on office space, but they did not include specific examples. The hope is that, you know, the further FAQs will kind of come out. And, you know, when you look at the life cycle, some people are in week 6, you know, approaching week 7. So, you know, unless, you know, and again, it looks like maybe it will get extended. I know there was a question, if we extended to 24 weeks, are people still going to be subject to the 8-week period? If the assumption is that they expanded to 24 weeks, you're still going to be eligible to continue to use the funds during that 24-week period instead of just limited to the 8-week period. But again, it's the reason we didn't specifically cover a lot of this, because usually these rules come out with qualifications, right? So who knows what the bill is actually going to say inside of it, and as far as, you know, it's everybody's going to be eligible for it. You know, there's still loan availability out there, so the hope is that this covers everybody, and not just saying, oh well, if you get a new loan now, that you'll be subject to these costs. But again, it's difficult to kind of speculate on what is out there. Again, the House bill has been put out there, but we've seen this before, where, you know, the final product has been drastically different than kind of what's out there.
I'll just add, a lot of my clients have said, Michael, here's what I'll do. I'm just going to present it for forgiveness and let them tell me that it didn't qualify.
Okay.
Yeah, you know, one thing to consider is, so we talked about there's 2 interim final rules, one related to borrowers, the other one I think was more towards lenders. You know, although lenders have been essentially let off scot-free from, you know, if somebody applies and they didn't qualify, they were, you know, essentially given a clean slate as far as, you know, not being held responsible for people that, you know, maybe didn't qualify, that weren't eligible, or they weren't, you know, they didn't submit accurate loans. But what the new rules came out and said was that if the banks basically qualified for a 5% fee, and if during the final stage, the review stage, it appears that you know, the SBA doesn't agree with either eligibility or the forgiveness calculation, or, you know, so if somebody wasn't eligible and they were deemed eligible, they will be able to claw back that 5% fee from the bank. So I think that the banks, you know, to Michael's point, you know, they are certainly vested in it, and you know, certainly can provide additional guidance as to what they feel is eligible and not eligible, because, you know, they are now somewhat on the hook, at least for that 5% fee that they got for your loan.
Thank you.
Steven, anything else out there?
No other hands are up at this point.
All right, I wanted to kind of just cover real quick, and BJ touched on this briefly. During the 2 interim rules, they did give specific examples, and BJ talked about one of them for the non-payroll costs. Just questions that we received, and essentially this kind of gets into somewhat of a still gray area. When you elect the alternative coverage period, you know, it aligns with the date that, you know, you essentially incur a pay period. But you can incur a pay period, and let's say if you're 2 weeks back or 1 week back, and so the first week you're going to incur it, you're not going to pay it until the following week. So what the interim rule gives as an example is that, you know, what qualifies for forgiveness is what is paid, and then additionally you can add in your incurred weeks, which opens it up to the interpretation that possibly you can qualify for more than 8 weeks of payroll. You know, similar to what BJ described as the non-payroll cost, where, you know, you qualify for more than just the 2 months of utilities or rent. So again, something to consider. It all might become a moot point if they extend, to 24 or 14 weeks, where you would be able, to have additional time to qualify payroll costs. But it did open it up to that. Another question I think that we got, and I still don't think is resolved. And again, if they push back the date, then it might be a moot point too. But currently there's somewhat of a disconnect regarding the safe harbor language, which is, either as of June 30th or no later than June 30th. The issue that some staffing companies have raised is that the week of June 30th is a holiday week. So let's say you hit your FTE count to pre-crisis levels, on June 22nd. And then the week of June 30th, you drop back down just naturally, not because you're letting people go. Would you still qualify? And I think that's one of the things that still needs to be somewhat clarified. Whether it has to be as of that 6/30 date, or whether it could be an earlier date, no later than June 30th. So there is some the discrepancy in the language describing the calculation, and in the calculation itself. The calculation itself says what is your FTE count as of June 30th versus the language describing says no later than. So still some things to consider, still some things to clarify. And then again, in the next day or so, we should have updated guidance on what the Senate is kicking around, which could expand some of these restrictions and make people's decisions a lot easier, and not have to necessarily, pack stuff into an 8-week period, and give people some flexibility that haven't really opened yet. Anything else, Stephen?
Nothing else.
All right. So, again, if anybody has any other questions for us, feel free to reach out to us directly, and we will certainly keep everybody posted, including Dorian and the members of this organization on kind of what's up next. So thanks everybody for joining today.
Thank you.
Thank you, everyone.
Thank you.